Hello, welcome to Trader Village Academy. In this video, we are going to discuss options trading and the following topics. What is options trading? Options trading allows you to buy or sell instruments like stocks, ETFs, or index funds at a specific price within a specific date. This type of trading also gives buyers the flexibility to not buy the security at the specified price or date. Buying and selling options are carried out in the options market. Let's take a look at the 4 key features of options trading. Number 1, call options. Number 2, put options. Number 3, leverage. Number 4, hedging. What are call options? A call option is a contract that gives the buyer the right but not the obligation to buy a specific asset at a specific price on a specific date of expiry. The more the market value increases, the more profit you can make. Example of a call option. Let's say that you thought the share price of Apple Company was going to increase from its current market price of $20. So you decide to buy a call option with a strike price of $25. For stock options, each contract is worth the equivalent of 100 shares, but the price is usually quoted for just 1 share. When dealing with options, there is always a premium to be paid. If the premium of this option is $1 per share, your total premium would be $100. If the price of Apple shares did rise to a market price of $30, you could buy that stock from the seller at the agreed-upon strike price of $25 and resell it into the market for an immediate $5 profit per share. This would earn you $500, but you would still need to subtract your premium, meaning your overall profit would be $400. If the market moved against you, you could let the option expire and you'd only lose the initial $100 premium. What are put options? A put option gives you the right, but not the obligation, to sell a stock at a specific price, known as the strike price, by a specific time at the option's expiration. The more the market value decreases, the more profit you make. Example of a put option. Let's say that you thought that the share price of a gold company was going to fall from its current price of $30. And so you decide to open a put option with a strike price of $25. For stock options, each contract is worth the equivalent of 100 shares, but the price is usually quoted for 1 share. When dealing with options, there is always a premium to be paid. If the premium of this option was $1 per share, your total premium is $100. If the price of gold stock did fall to a market price of $20, you could execute your right to sell the stock for the agreed strike price of $25 a share. To calculate the profit, you subtract the market price from the strike price, giving you a profit of $5 per share. Since put options come in lots of 100 shares, you multiply that $5 per share profit by 100, which yields a gross profit of $500. After deducting the $100 premium, you would be left with a net profit of $400. However, if the market had moved against you, you could let the option expire and your maximum loss would be the cost of the initial $100 premium. What is leverage in options trading? Leverage is a powerful tool that investors and traders use to magnify the power of their money. In options trading, leverage refers to the ability of options contracts to multiply the power of your capital. Options have a leverage factor associated with them. This factor is applied to your money when determining how many contracts you can purchase, and it increases as the price of the contract increases. This means your profits can be magnified, as can your losses if you're selling options. For traders looking for increased leverage, options trading is an attractive choice. By choosing your strike and trade size, you get greater control over your leverage than when trading spot markets. How can you hedge with options? Hedging with options allows traders to limit potential losses on other positions they might have open. Say you own stock in a company, but were worried that its price might fall in the near future. You could buy a put option on your stock with a strike price close to its current level. If your stock price is down below the strike at your option's expiry, your losses are limited by the option's gains. If your stock's price increases, then you've only lost the cost of buying the option in the first place. Benefits of options trading. Buying options requires a lesser initial expense than acquiring stock. The price of obtaining an option, premium and trading fee, is a lot cheaper than what a trader would have to spend to purchase outright shares. Options trading lets investors freeze the price of their stock at a specified amount for a certain period. Depending on the category of the option used, the fixed stock price, also known as the strike price, guarantees that one will be able to trade at that rate at any point before the options contract expires. Options trading improves a trader's investment portfolio through added income, leverage, and even protection. A common way of using options to limit one's downside losses is in the form of a hedge against the declining stock market. Furthermore, options can be used to produce a recurring source of income. Options trading is inherently flexible. Before their options contract lapses, traders can employ various strategic moves. These include using options to buy shares to add to their investment portfolio. Investors can also try buying the shares and then selling some or all of them at a profit. They can also sell the contract at a higher rate to another investor before it matures and expires.